BigBear.ai is one of the more volatile stocks in the market this year. The stock price has moved violently up and down in 2024. I've had BigBear.ai stock rated as a hold, and I've told investors not to buy this stock this year. I'm going to update that recommendation in this video. The company reported financial results, which I will review with you in this video, and then update my recommendation for BigBear.ai stock and let you know if I still think you should avoid this AI stock. So let's get into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So like I highlighted at the top of the video, the stock price movements have been violent for BigBear.ai. You can see this big jump upwards here around March of 2024, where the stock price jumped from a little under $1.50 per share all the way up close to $5 per share. Now, I didn't get caught up in this hype, and I told investors to fade this trade. In other words, avoid buying it based on this momentum here. And if you followed that recommendation, you will have saved a tremendous sum of money because the stock price has absolutely collapsed the rest of the year, and it's now trading at $1.34, which is lower than where it started the year at over $2 per share. I last updated BigBear.ai on May 7th, and I told investors that it was still not a buy. So let's take a look at the latest results and update that recommendation. So in terms of revenue, the company reported $39.8 million in revenue in the latest quarter, and that was up only 3.4%, which was disappointing considering that this included results from an acquisition the company made last year. One of the good news from the quarter was that it signed a master service agreement with Heathrow Airport to deliver advanced technologies to Europe's largest airports. Now, BigBear.ai is a leader in AI-powered decision intelligence solutions. In the latest quarter, it launched its Conductor OS distributed platform investment, and this is built to be lightweight and works within any existing infrastructure to rapidly and seamlessly orchestrate sensor data and artificial intelligence models across highly diverse and distributed environments. Still, the latest quarter was full of challenges for BigBear.ai, and as a result of those challenges, they downgraded their full-year revenue outlook down to $165 to $180 million. Yet more difficulties for this innovative AI company. The revenue increase in the latest quarter of just 3.4% was impacted by the planned wind down of the Air Force program in mid-2023, but it was offset by a full quarter of Pangiam revenue in the second quarter of 2024. Pangiam is the company it acquired. So even with this acquisition and all their revenue being accounted for in BigBear.ai's revenue, its revenue only increased by 3.4%. A very disappointing result for BigBear.ai stock investors who are expecting big things and big growth from this innovative AI company. The net loss came in at $11.7 million for the second quarter compared to $16.9 million in the same quarter the prior year. BigBear.ai management made a concerted effort to cut costs and improve margins considering their headwinds they were facing. They wanted to keep costs low so that they don't lose too much money on the bottom line. The company's ending backlog was $266 million as of June 30th, 2024. And backlog is an important metric for BigBear.ai because eventually these turn into revenue. So the greater the backlog, the more likely BigBear.ai's revenue will be positive or growing over the next few quarters and over the next few years. And like I mentioned, the consolidated results include results from Pangiam from the acquisition date of February 29th, 2024 to the end of June 2024. So since those dates, the results from Pangiam is included in the results from BigBear.ai. And what will this do is make its revenue numbers look higher because now it has all of that extra revenue coming from Pangiam. It will make its expenses higher because it'll have that added expense from Pangiam. It'll make any of those numbers adjusted compared to the prior year because the prior year it wasn't operating with the Pangiam included. So the partnership between BigBear.ai and Heathrow Airport aims to improve security and operational effectiveness while enhancing the overall experience for travelers through UK's hub airport. And airports are an interesting place to use BigBear.ai's technology and increase convenience for people traveling. Airports are notorious for mismanagement and delays and long waits, and there's so much that can be improved with the use of technology. It's just in the early stages of development, and it's good to see that the relationship has worked well enough where it's expanding going forward. Now, for a company like BigBear.ai, I feel the operating loss is a more important metric to look at than the net loss on the bottom line, because they have several factors that increase and decrease the net loss that come below the operating loss line item, like interest expenses and the decrease or increase of the fair value of derivatives, which can be good one quarter and bad another quarter. This isn't core to the company's operations. So if you're trying to evaluate the progress the company is making, it's more informative to look at the operating income. And for BigBear.ai, it's getting much worse. In the 3 months ended June 30th last year, their operating loss was just $10.2 million. In the 3 months ended June 30th this year, their operating loss was $16.67 million. So while the company's revenue barely increased year over year, their costs increased meaningfully and the operating loss worsened to $16.67 million. So one of the ways the company is funding all of their losses is by diluting shareholders, and the share count increased by more than 100 million year over year. They now have 246.3 million shares outstanding. That's up from 145 million shares outstanding in the same quarter last year. And shareholder dilution matters for investors because if or when the company does eventually turn profitable, those profits are going to be split among more shares because there's more shares outstanding. All in all, you can understand why BigBear.ai stock price is down considerably, because the performance is not that of a fast-growing company. It's not growing organically. Its operating losses are worsening. It's diluting shareholders, and so it's not heading in the right direction just yet, even though it's got some innovative technology that could prove a positive potential for the company down the line. It's just not there yet. And it's trading at a relatively expensive valuation at a forward price to sales of 1.7. And so to update my recommendation for BigBear.ai stock, I would say it would be prudent to not buy or keep it rated as a hold, because the company hasn't yet proven that it's worth taking a risk because of its reward. Right now, its losses are worsening, and those factors I mentioned earlier doesn't seem very exciting, doesn't seem like it's anything imminent, and so I would prefer to wait on this stock, let the company deliver better growth, let the company improve the operating losses, let the shareholder dilution not worsen as much as it is, and then we can update later after the company demonstrates better progress. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.